One of the things that many people are looking for is to learn how they can trade based on the daily bias so that they can stay on track. In other words, be in line with the order flow. In fact, it's about figuring out what the daily bias is and how you can find it in the best way. This video will teach you that, and is the only video where you can learn everything related to bias. I will teach you 5 ways to find that bias and move along with the direction of the bias and trade in line with the trend of the bias so that you take on less risk and achieve higher profit. Let's continue with the video and review these points together. Well, one of the problems that many friends and traders have is that, for example, they are trading on the 1-minute chart but are looking for the daily bias. There is an important point regarding time frames. You should actually identify the bias relative to your own time frame. Generally speaking, if we want to consider bias, so to speak, in a scheduled or time-based manner, let's do that. Let me write this down for you so you know exactly. This is exactly where you need to perform this specific analysis. If I want to carefully consider a market bias and observe how the various time frames are actually structured, I first look at a monthly time frame for the long-term view, then move down to a weekly time frame for more detail, followed by a daily time frame to see the current trend, and then I continue further down into the lower charts from there, into the hourly, 4-hour, 1 hour, and after the 1 hour, we know there's the 15-minute, 5-minute, and finally the 1-minute. Take a look. Each of these time frames transitions to the next one by skipping over the immediate following time frame. That is to say, whenever I find myself carefully analyzing the monthly time frame, after that is done, I should execute and place my specific trade on the daily time frame. On the daily time frame, and then simply let the position run its course. Let me go ahead and change the color of this element as well, so that it becomes a bit clearer for everyone to see. Let's see the difference here. Okay, if I am trading on the weekly time frame, meaning I am analyzing the weekly chart, the next time frame would be the 4-hour chart. If I want to confirm it, actually the confirmation time frame would be the 1-hour chart. Daily means actually in the context I am also looking at the monthly charts. The daily bias is also determined, and by matching it with the daily bias, I can confirm its direction on the 1-hour chart. Similarly, the 4-hour chart is used for the 15-minute time frame and the 1-hour chart for the 1-minute time frame. Well, it's the same for the 5-minute chart, meaning if I want, I can also confirm on the 5-minute time frame. I need to look at the 1-hour chart, and on the other hand, the 1-hour chart is based on the daily chart. So this is exactly how the arrangement of the various time frames works.
7 powerful volume trading indicators: footprint, volume profile, and fast scalp. Level up your trading.
If I want to confirm my analysis using higher time frames, meaning I want to confirm with the much higher time frames, it would typically be the monthly, the daily, and the 1-hour charts. Well, if I want to do it at the intermediate level, meaning right in the middle of the various time frames, then it would look exactly like this. First, I look at the weekly, meaning I use the weekly time frame for the broad trend. Then I move down to the 4-hour chart, and after that, I analyze the 15-minute chart for entry. Basically, that is how I execute my trade. And if I want to scalp or trade on much lower time frames for quicker moves, I follow a similar but faster sequence. I need to start my analysis from the higher time frame 4-hour chart, then look for confirmation on the 15-minute chart, and finally execute my entry position on the 1-minute chart. So definitely keep this process of analyzing time frames in mind. This is one of the most important parts. You can't just trade on the 1-minute chart if you want to. You can't just look at the daily time frame and then say, for example, my bias is bullish, so I'll analyze on the 1-minute chart. And then wherever I get the chance, just take a buy position. Execute my buy trade, and that's simply not acceptable. That means your risk is extremely high. In fact, you don't even know whether you're moving in the direction of the bias or against the bias. This can create a very high risk for you. So in order to actually identify biases, there are 5 methods. Let's go over the methods. Let's look at the first method so you can learn how to identify it and improve your trading. You can effortlessly accomplish this task in your specifically preferred time frame. Now, before we dive deep into the MetaTrader tutorial, I would like to share some additional important information with you. Now, let's take a look at a specific example.
Learn and enter the world of binary option with us. Binary option indicators, powerful strategies, learn, trade, win. Level up your trading.
Suppose we are analyzing a standard daily candlestick on our chart. If this particular daily candlestick ends up closing in a profit, which in other words means we are assuming it is a bullish green candlestick, then we need to consider the implications. Just a moment, let me go ahead and draw this out for you one more time so it is perfectly clear. If we assume that we have a profitable candlestick and it started from here, this daily candlestick, in fact, is moving in the lower time frames. It moves like this until it actually reaches the liquidity area. If there is liquidity here, this daily candlestick is moving toward that level. You see these kinds of movements, meaning a movement, an expansion move, retracement, expansion, or actually a correction. And in this situation, you see this. As a result, if you decide to trade against the market trend, the level of risk you are taking on goes up significantly. And well, you could lose everything. Actually, in the short term, actually during the corrective moves, you should trail your position. That is, well, there's a higher risk, but you need to know, meaning you need to know that you're moving in an upward direction. At that time when you're trailing during the correction, we understand how long to keep your trailing stop, when to take profit and exit, or if the correction doesn't happen, to close your trailing stop. Basically, it's about strong risk management. In fact, you need to be more focused. But when you know that your daily bias is upward, when you enter your trade here and actually open a buy position, you already know that you can hold your trade until the end, and it carries less risk. In fact, your capital becomes more secure, but in cases where you want to trade long term, well, when you see a movement happening, there's a pullback, and then the movement wants to go up again. Here, a BOS, break of structure, occurs, and the likelihood that this retracement, which is actually a retracement, there might be an FVG, fair value gap, for you here, and in fact, this is a retracement. Now, I'll write it very briefly, the retracement that happened here. In this path, it came and hit an internal liquidity and then made its expansion upward. And this is actually suitable for longer trades. Now, if you assume that in this retracement, you entered a trade at this internal liquidity, you are moving toward the buy side. Basically, you are making a bullish momentum trade in a bullish trend, and you have taken a buy position. Now you hold your position until reaching the next liquidity, and you can keep your trade open. Keep in mind that along this path, there might be other retracements as well. So consider this point too. All right, let's go and review one example, which you can do quite easily. You can proceed with the steps. Look, what I want to tell you is what the market is actually doing during price movements. You see the market is either moving toward liquidity, meaning it identifies a liquidity area. It finds the liquidity and moves toward it. Or in fact, these liquidities are usually external, but they can also be internal. Well, most of them are considered external, or actually the price is moving to address the FVGs. These specific market areas where the price action has not yet fully filled and an FVG has occurred are essentially waiting for the market to eventually return in order to rebalance them properly. That is, to establish a more stable price equilibrium over the specific areas where there are FVGs, so that these zones are also completely filled and mitigated. which are frequently left behind as open liquidity gaps in the market. These are actually recognized as internals, and the market's movement is essentially always shifting between liquidities and rebalancing FVGs, and it continues its movement along this path. Besides that, now, in order for us to be able to accurately identify and track various market order flows, and to be able to effectively implement a highly disciplined and proper order flow strategy, it is absolutely essential that we really need to look very carefully and analytically at the specific PD arrays in the market. That is in the context of the premium discount range and price, meaning, for example, if a price is moving, let's assume here that this is the ceiling. If this is the floor here, then the price is in this state. If we want to actually take a bearish trade, in other words, to initiate a short selling position, well, right here, in the absolute ideal best case scenario for us, the price reaches a level where it is at its most expensive point. And if the price eventually returns to this area, in fact, within this specific liquidity zone, if we want to take a buy, the price is currently trading at its maximum possible discount level. That is, in fact, here it is in its discount state, and we can go ahead and take a buy trade. So we need to consider where these liquidity zones are located in relation to the price. By examining what is happening now, what condition is the daily bias in? Is this PD array, for example, sweeping it or breaking it? We can decide whether to enter that trade. All right, moving on. When we want to talk about our first method, in fact, our first method is a very simple one. In fact, the method that we can write this down as our first method, actually, when you combine all of them, they are known by this same name. They are all the same. A rejection or a liquidity sweep is supposed to happen. Or alternatively, the turtle soup strategy can be used. All of these are actually the same. In how many ways can this happen? Suppose I draw the candles correctly so we can use them. For example, look at this. The candle is here, the price condition is in this favor, and then I want another candle. This bearish move happens, and here a liquidity event has occurred for me. Now the rest of the candles or the movement path continues. At the lower price and in this lower area, I have another liquidity event here as well. Here, the price still hasn't moved upward yet, but in fact, after this candle forms, the next candle starts its move upward. So now my liquidity has formed here, and I also have liquidity up here. Then the next candles move and get close to. In fact, my liquidity that is located here, at this point, I need to check the price condition. I need to see which scenario is actually going to happen if, let's assume that a candle has formed here and it has come and swept this liquidity. I know that here, in fact, a price rejection has occurred and the price wants to move toward another liquidity area. When this candle closes and has swept these levels, I need to form a setup. A setup that shows it's moving downward again, and then the next candles form. It comes, and now if we assume that it gets close to this area but hasn't reached it yet, it can. In fact, with the next candle, it could be a bullish candle again. Here, a correction is happening, and well, here it has created another liquidity for me, as you can see. Within a move, a correction has occurred, and also a liquidity has occurred. Here with this candle, it comes and sweeps this again, and I can analyze that. Now, in fact, the price wants to move upward again, to move. As a result, the next candle is also a bullish candle, and then another candle forms after that. So what happens here? Here it has come and completely actually broken my liquidity and moved upward. If we extend this further, I want to show you how it can happen again. The next candle also couldn't close above that level and got rejected again. Notice that my liquidity has been swept and it has moved upward again. Of course, there's also an important point here. I should actually mention this to you so that you're aware. Look, now here a new high has been formed, right? In fact, this becomes my next liquidity. This candle and, well, its wick must definitely sweep the upper side, and then the price can get rejected here and move downward, either until it reaches this liquidity or reacts to this very FPG. Move upward internally. Well, this was an example of our first method, which you can make decisions based on liquidity and the price's reaction to liquidity. You determine which direction the bias of the time frame we're using here is moving. For example, here, where it broke this, if the price on a lower time frame comes back down and actually within this candle returns down to a zone where it can trade with that, you can open a buy position here, and since it's in the direction of the buy, you receive your desired characteristics, but you endure less risk. For example, here you can see there was actually a resistance. I'm looking at UR/USD on the 4-hour chart. We're observing it together on the 4-hour time frame. There was liquidity here, the price was rejected, and it came down. Now I want to go to the 15-minute chart and analyze this. All right, let's take a closer look. Now here, it's come down to the 15-minute chart. I'm seeing its breakout right here. It formed a lower low and then came back up, actually retracing this move. Then it came back for a retest, but basically tried and couldn't close above it with a single candle. In fact, a shooting star formed, and with the closing of this candle, I could have entered the trade. And well, it was a bearish trade too. As you can see, after that, the price dropped sharply and significantly, and I could have gotten a good TP with minimal risk. Let's look at another example together as well. Let's see on the 4-hour chart where I could have had a rejection. All right. Here as well, you can see I have a liquidity area that was rejected here, and in fact, it didn't close above it, so I could have taken another trade. Let's check it on the 15-minute chart and analyze this area as well. Let's see here. Well, as you can see here, the price shot up again. It formed a resistance here, so I couldn't enter a position at this point. In the FPG zone, here actually, we're at a pigment to BPA where the price broke through the level and reacted to it again. It couldn't go above the zone anymore. And with the price dropping here, I couldn't enter a position. I can't take an entry here. Actually, none of these zones, in our opinion, could give us an entry. There's a BPR as well. We have one right here too, but again, no entry happened here either. It didn't even happen further down, and I couldn't have an exit either, but the plan is still bullish. If you look at it, actually, even on the 15-minute chart, if you check, our trend has been a downward trend on the 15-minute time frame. For this alternative approach that we are discussing, you actually need to carefully observe and analyze the specific way price fluctuates between internal and external liquidity. In fact, there is a continuous process of price movement between external liquidity and internal liquidity, which refers to the fundamental flow of market orders. This is fundamentally identical in its core execution to the MXM strategy. For example, let's say we have a price movement forming a swing to the upside, then a correction, and then again moving upward. Here, this could actually be an external liquidity area that the price is moving toward. And within this range, within this swing area, there could also be an internal liquidity area. As a matter of fact, it is important to know that there could also be an FPG located right here in this specific area. Now, when the price eventually wants to return to this external liquidity once again, that is to fully fill this FPG and reach this external liquidity level, the specific manner in which the market moves to achieve this can vary significantly. it might form a series of different market swings and price fluctuations in order to reach this FBG and properly address this existing price imbalance. Now, whether it fills it or just touches it and then moves again toward our external liquidity, and in fact, this FBG, which is an internal one, gets hit, this is an internal liquidity, and then it moves toward our external liquidity. In reality, price movement is always from one external to an internal and from one external to another external. It's external. If we want to take a closer look at its specific candlestick form as well, let's say a clear candlestick has formed right here, and now I have a significant liquidity point established in this area. After that occurs, the next series of candlesticks that are currently forming are ones where, in fact, a strong bullish candlestick forms right here. But if we observe the price action closely, well, it still hasn't reached the order block yet. Now, suppose we have a candlestick like this. The next candlestick comes, it becomes a doji, and the following candlestick also moves upward. Now, right here, we have an order block and an FVG, just like the swing I was showing you in the previous example. This is also an FVG, right? This is an internal structure we are looking at. In fact, what we are seeing here is an IRL, which is internal range liquidity. Notice how the price is also moving in a clear upward direction. And as it moves up through its own internal swings, it starts to form another level of liquidity right here. This becomes our external range liquidity. Essentially, our external liquidity has now fully formed. Once again, if we look closely at what happens after this particular swing, so at this point where a high has formed and the price is moving downward, let's assume the price is still coming down and bearish candles are forming. Now, as it approaches this FVG, we should see a candle that enters the FVG, and it might even sweep this liquidity as well. Both scenarios can happen together. This means that the candle opens, it's a bullish candle, and it enters the FVG. It might also sweep the liquidity and move toward the external liquidity. Then another candle can form here. At this point, it could either react to this level and form a higher swing, or it could sweep this level as well, and the price could move downward again, or the next candle could go up. Yes, that is correct. And now this is actually our second primary counting method. In this specific approach, you can effectively use both internal and external liquidities to accurately identify the daily bias and the higher time frame trend. Once you have established that clear direction, you can then look to enter your trade with confidence on the lower time frame. All right, now let's go ahead and look at a detailed example together to see how this works in practice. All right, for example, let me just go ahead and move this element out of the way and label it clearly as 3, 2, and 1. So for instance, if we really want to sit down and analyze this specific setup, we can clearly see that there is a significant amount of liquidity sitting right here, and the price action has actually rejected this liquidity zone quite strongly. I am currently looking at this on the 4-hour time frame to get a better perspective. And then again, right here in this area, I have another very interesting point to consider. Looking at the chart here again, I have an FBG identified. And right here in this zone, the price has come back into this FBG. And once again, it has moved toward this specific level. Right here, by carefully transitioning our operations from this specific internal framework out to the broader external market environment, I have successfully managed to secure another substantial profit for our venture. It is truly remarkable how moving through these different stages of the business cycle has allowed us to consistently see such positive financial returns and growth once again. All right, now let's look at another example together. For instance, look here. I want to show you the opposite scenario. Here, an FPG has occurred, the price has entered it, and actually the external liquidity is the same as what exists here. It has entered an internal, then moved toward the external again, and then returned to the same internal. Of course, this internal has pretty much already been used, but anyway, in a more professional model, which I'll explain to you in another video later, I'll tell you why there was a reversal. in this FPG in this video. Anyway, here we had a rejection. Our next liquidity area is this zone, and actually now we have an external here. Our lower external is here, and there's another external in this area as well. The price action is constantly moving back and forth between these internal and external levels, and well, this phenomenon actually happens across all different time frames. If we decide to change this specific internal point, it essentially becomes just like method number one, and there's really no significant difference between the two at all. We have specifically added this second method so that we can also carefully analyze the price movement right in the middle of the path. Furthermore, it also includes the external levels as well. All right, let's move on to the next part, and I will teach you the third method as well in the following section of this video. All right, now let's move on to the third method in our strategy. This specific third method is primarily based on identifying specific candlestick patterns on your chart. In fact, the entry signal is triggered when either a clear candlestick pattern forms or a change in state of delivery, also known as a CISD, occurs in the market. That is, CISD stands for change in state of delivery. This actually refers to a change in the way price moves, which we can observe in two candles on a higher time frame. Now, for this method to be valid and for us to actually use it, it must definitely occur within a POI, that is a point of interest. And after that, we should see this candlestick and this reversal pattern. Now, the POI, this could potentially, for example, be identified as something such as a significant FVG, or for instance, a specific order block, or even a breaker block. And now, looking at specific market instances such as these liquidity sweeps, we see situations where we have a substantial amount of resting liquidity, and that liquidity is effectively and rapidly swept from the order book, creating a significant shift in the immediate price action, which is very similar to those previous cases where in the previous examples we had a candle that was at the top or bottom, liquidity would form there, and then it would get swept. After that, we might see such candles, or in cases where we have SMT in pairs and indices, and situations where they are actually cases that are correlated with each other, and based on those we can analyze a condition. For example, EUR USD with GBP USD. All right, let's go and actually analyze a candle together, see how it should be. Let's take a closer look at the specific candles within this pattern. Allow me to demonstrate for you a couple of clear examples of how these candles behave. Now, look closely as a bearish candle begins to form on the chart. Notice that this bearish candle establishes a specific low point, right? Following that, the next candle is a bullish one that actually comes down and sweeps below this previous low point, right? And yet it itself still manages to remain contained within the overall body of that initial red candle. There are also some variations of it. The very next candle that opens up will do the same thing to this previous candle. In fact, it closes above that. It also closes above the first red candle. And when this situation occurs, I can actually analyze it on a lower time frame and find my entry point. I should actually do this based on the time frame we have, whether it's 4-hour, daily, or weekly. For example, it has become bullish and is making its move. This also, in fact, looks like a V on a lower time frame, meaning the price came down. It dropped, basically. This happened. It came down lower than that, and then the price moved upward. But there is another pattern as well, which you can also see in this way. That is, a bearish candle has formed. Again, we mark its high and low. But the next candle that opens is a bullish candle, however. It remains within the body of the bearish candle and does not close above its high or low, but the next bullish candle that opens closes above the low of the first bearish candle. As soon as it breaks through the Kijun and turns bullish, well, this can also be very powerful, and in fact it should determine that time frame and the movement in the lower time frame so that we can find a good entry point and enter the trade. But in the case of the pattern that is now a 2-candle pattern, an engulfing candle occurs. If we have a bearish candle here, the next candle, this formation is known as a bullish engulfing candle, which is a signal that completely surrounds and engulfs the entire body of the previous bearish candle. This means it fully covers the prior candle from the bottom and then closes with a distinct shadow on the top. And this is actually like a situation where the price movement comes down like this and then goes up. That means a change of state has occurred in the bullish trend. Here, it's as if a break has happened and we can see a trend reversal here. We can observe it. This is also an example of CISD, which actually means that in the lower time frame, a market structure shift has occurred. In other words, in the lower time frame. You can see it happening right here in the lower time frame. Here, in fact, a break has occurred and the price has moved in the opposite direction. This happens in exactly the same way in both bearish and bullish scenarios. It's possible that the position of the candles might change. All right, that's it for the second method. Let's move on. Let's look at a few similar examples on the chart so you can identify them. Here's an example right here on the chart. We're actually on the 1 hour silver chart where this has happened. You can see there's liquidity here. This liquidity has actually been swept. All right, its pivot point has formed, and in this, let me make this area a bit bigger. You see a bearish candle has formed here, and there's also an engulfing candle. It closed above that and is pushing the price upward. A bullish move has actually occurred here, indicating that the price is moving upward. So let's continue. Now, if you assume you want to make a trade, you need to see if on a lower time frame, this area has given you an entry point or not. We can check it on the 1 minute chart. Let's take a look at this area right now and see if it's still within this same zone. Here, if we take an FPG at this valley, right here in the entry zone of this FPG, we should have been able to actually make our trade. You see, there's a large FPG here. The price came into the FPG and we should have been able to enter. So would you definitely have hit your take profit? Okay, let's look at another example. We also need to review another one. All right, let's look at another example here on gold. Here there's actually a breaker block and this zone is reacting to it. So in this range, in this set of candles that you see, here you can see that this candle has actually formed inside the initial bullish candle. Now, looking at the third candle in this sequence, which opened up, it has steadily moved down and eventually closed at a level lower than our very first candle. Interestingly, this specific candle has managed to close both significantly higher and lower than that previous one. And as a result, what we are seeing here actually indicates a shift. A secondary pattern has formed, and you could probably see that there is an FVG here. With this entry, or actually with this entry and this FVG zone, you might take action yourself. And now on a lower time frame, I'm looking at the 4 hour chart right now, but if you go to the 15-minute time frame, that's when you can find the entry point. You can see the best one right here. Moving on to the fourth period of our analysis, we are going to focus more on the individual trading sessions, and by examining the behavior during the Asian session, we can achieve this objective. This allows us to identify a series of price movements occurring within that time frame. In fact, if we observe that the Asian session forms a range and its lower boundary is swept, we can then identify a bullish trend. And if its high is swept, we can identify bearishness. Of course, this trend can happen more often during the London session, but it can actually, or even, I mean, it can also happen during the New York session, and it's also possible that it doesn't happen at all. That is, if we get this signal that our trend has actually swept the Asian session's low and has become bullish as a result. It continues during the London session, but for New York, there's a chance that it might not happen. So actually, this could happen either during New York or during London, or it could happen during both sessions. As a result, when we actually enter the New York session, we need to pay attention to this and analyze the situation because we actually need to be able to form this. Basically, we check the Asian session and wait for it to sweep either the low or it is looking for those previous highs, in fact, to be completely swept away. If this specific scenario happens, meaning if that price sweep occurs right at the swing low or the swing high, then we have what is known as a market structure shift, and immediately after that, a strong displacement occurs. And in fact, that's when the price starts its movement, meaning when you have this Asian range, and here a sweep occurs. Specifically, a low sweep happens, followed by a displacement, a bullish candle. The displacement moves toward an upward trend, and here a market structure shift also takes place. Here, if you suppose, let me erase this. Let me draw it for you one more time, if you suppose. Let's imagine that we are currently trading within the Asian session and a liquidity sweep suddenly occurs across the market. Then it is quite possible that a specific reaction follows. In fact, a correction happens. When the low sweep happens right here, in fact, a significant market structure shift occurs. After that specific moment, with a very strong and decisive candle, that impulsive move happens. A clear displacement occurs and the price movement starts to aggressively go upward, and here we can clearly see it unfolding. We actually see the market as being decidedly bullish when looking at the higher time frame perspective. Now, if we consider it bullish and look for an entry point in the lower time frame, we can find a good spot and enter the trade. Of course, regarding the Asian session strategy, I will definitely record a separate video for you so that you can use it. And first of all, so you can actually benefit from the Asian session strategy. You can use it if you want to trade during the London session. Let's move on to entering a trade. Let's review an example of this together. All right, to see examples of method 4, which is related to the Asian session, to begin, you can navigate to the Indicators tab in TradingView and type Session into the search bar. After that, you will see several options for session indicators. Session, session. Take a look right here. You will see there is a specific session labeled as Pool Market. There is another one called TFLAB, and once you click on that option, it will actually display the sessions on your chart. You can go into its settings, set it to TFLAB, and in your settings, make sure it displays the Asia session. You don't need the other options. You can also add London and New York. Enable their display and click OK. At this point in the chart, you can clearly see the Asia session and observe the market conditions during this time. Right now, in this highlighted area, we can identify that this point represents the low of the Asia session. Let's mark it for our analysis. I'll mark its low. Here the low has been swept and the price has moved upward. Again, here as well, look, this is the Asia session. The Asia session's low has been swept. The price has moved upward. Here it's been swept towards Asia. Again, you can see on the 1-hour chart, the low has been swept and the price has moved downward. And well, there are many such cases. Now, I will definitely cover the Asia session strategy in a dedicated video. In fact, I will explain these points in more detail, showing you exactly how to use this method. But for now, to be able to use it easily, it's enough to just know about the sessions. And now look at this case. Here the session has been swept, but the price hasn't gone up as much as it should have. It formed a consolidation, created some swings, and then dropped downward. Of course, you should definitely pay close attention to the fundamental and news conditions as well. Here on the euro to dollar chart, again, the Asian session has been swept and the price has moved. It went up. Let's see, is there another example where, again, the Asian session swept the low here and the price went up? Here too, the Asian session swept the low and the price went up. Well, we can certainly take a moment to analyze these specific types of cases. let's move forward, and in fact, we should also take the time to review the very last method as well. And then after that, we will finally wrap up this entire video. Well, for the last method, actually, it's a very simple method, and well, it can't really be considered as in fact, it can't be called a very powerful method, but it is a method that is very simple. One technique that many traders find incredibly helpful when analyzing market trends is the use of specific indicators. You can utilize the EMA indicator, which is more formally known as the exponential moving average. When working with these moving averages, you should actually apply both the 9-period and the 18-period averages to your chart to see the results clearly. When the price candles are positioned below these lines, if we assume these represent our two EMAs, this indicates that when the candles stay underneath the price, it shows the market trend is moving in a downward direction. It's a downtrend, and if the candles are above the 9 and 18 EMAs, it shows that the trend is upward. If the candles are in the middle and you can't really identify anything in this area, we don't have an opinion and we can't determine whether the trend is actually upward, whether you like it or not. The truth is that we simply can't make a trade here. Well, in order to actually be able to successfully make this specific trade happen, now all you really need to do is navigate over to your trading chart. Just let me clear all of this off first, and then we can both go over to the chart together. In the indicators, you activate the multi-EMA settings. Now, you can place this specific layer right on top of the new one. This is the second layer on 18, and it fits perfectly. Okay, now you select the color you want. You specify EMA 1 and EMA 2 in order, and here you can clearly see it now as we look at the chart. For example, in this specific area, the price is consistently staying well below both of our EMA averages, and we can easily observe how this trend continues. Clearly identify a downward trend, but here, look, there was a price fig here. Well, the price entered that area, but is still below the EMA, and it could have, here, for example, a downward trend could have occurred. Let me improve the color here. We could have clearly identified a decline. Considering that your chart is on the daily time frame, we could have made a good entry in this area. We could have had a very profitable trade. All right, let's look at another example. Let's analyze it together as well. Now, for instance, again, in this area, the price is completely bullish and has moved above the moving averages. Again, here, I have an FPG where the price entered that area, and once more, a very good profit was made on the chart. Actually, this strategy and this method 5 are very simple, and it can be helpful, but on its own, it can't do everything. It's not a method that you can rely on 100% to identify it completely, but in any case, it can be very helpful and show you the bias. It can show you the price conditions very well. Well, to sum up, if I want to give a summary, first of all, you need to pay attention to the daily bias. You should definitely calculate it based on the time frame, meaning those points I mentioned at the beginning of the video regarding the time frames, make sure to keep those in mind as I told you. Monthly, weekly, daily, 4-hour, 1-hour, 15-minute, 5-minute, and 1-minute. Each of them represents a single session. In fact, each one is a specific time frame. I would skip one and move on to the next. Be sure to keep this point in mind after this. That brings us to the point that the price and the market operate in such a way that they are either rebalancing the FPGs. It either performs FPG rebalancing or is actually seeking liquidity. So liquidity is always very important. Sorry for my messy handwriting. I'll write it down. The market is always moving between these two, in fact. Whenever we want to select the most appropriate trading range, in order to enter the price effectively, we definitely need to accurately identify and categorize our specific PDR items. And we also need to have a comprehensive understanding of the various PI items, such as fair value gaps, order blocks, breaker blocks, and the liquidity pools that exist within the market structure, which can be very effective. And we must definitely utilize these specific components at the precise locations and moments where we are actually looking to establish a consistent supply chain. And we also need to carefully identify exactly which ones we actually want to use in this process. All right, that was our first method. Let me erase this. Our first method was actually about rejections. That is, cases where liquidity gets rejected. Price rejection must exist in the hard zones and at the base of the method. Our second method was actually about external and internal liquidities. We previously discussed both external and internal liquidities, which we often refer to as MMXM. Moving forward, our third method focused on the detailed study of candlestick patterns. Additionally, we examined the change in state of delivery, or CISD, which we have already reviewed together. Now, let's transition into discussing our fourth method. It was about the cases where we had the Asian session, the sweep of the Asian session, which we reviewed, and the fifth option was also related to the EMA indicator, where we had the 9 and 18 settings actually in its configuration, and now if the price was late there, we could identify the cause, and if it was above that, we would have a profit, and in the middle, we couldn't. In fact, we didn't have a clear picture of the bias. Be sure to set the time frame accurately. For example, if you are reviewing it on the 4-hour chart. You can also check it on the 15-minute chart. I hope you make use of this video and are able to make better trades. That's it. Also be sure to follow and subscribe to me on social media, especially YouTube, so you don't miss the latest videos. Soon there will be videos related to the station strategy. I'll cover Asia for you as well. I'll share it so you can also make good trades through that. Have a great day and goodbye.